There's an old Wall Street saying, it's not a stock market, it's a market of stocks. The market's comprised of several industry groups, each reflecting the business conditions in their respective slice of the economy. The behavior of these industry groups can really tell a very interesting story. Now, we're going to show you what's happening inside the market, reading between the lines, and you're going to see the internals, they're quite troubling. This is the year-to-date performance of the different industries represented in the S&P 500 since the beginning of the year. The strongest sector by far has been the white line, that's utilities, followed closely behind by energy. Conversely, on the downside, one of the weakest sectors is consumer discretionary. Even below that, information technology. And then our Mag 7, the seven magnificent stocks. Not so magnificent these days. We're going to break down what is going on and why this is so important. Number one, the up days are led by defense. The down days, well, we see a continuous decline of those former growth stocks. Here we can see the different sectors at the top represented within the S&P 500. Now, what we've done is these are all the trading days since the beginning of the year, isolating only those significant days. A significant day is when we see at least 1% up or 1% down on the S&P 500. That's on the left-hand side. And what we'll see over here is, first of all, the S&P 500 since the beginning of the year down 8.6%. Just adding up these big days. Let's exclude all the little noise. Now, with that said, what has correlated with these down days? We're trying to look for the other sectors that have been mostly correlated with the S&P 500 when it's down a lot. That includes information technology, consumer discretionary, and the Mag 7s. Now, when the S&P 500 has been up at least 1%, that has very strongly correlated with utilities and consumer staples. There's a big difference between the two. Now, what we've done is for each one of these industries that we've mentioned, we're isolating the top 10 by market cap, the top 10 holdings. So, for example, consumer staples in the left-hand side, Costco, Coca-Cola, etc. And what we'll see here, first of all, the strongest stocks, that's on the left-hand side, consumer staples and utilities. Consumer staples are things that we not necessarily want, but we need. Things like Procter & Gamble, Target, Walmart, everyday shopping. Utilities, that's energy. They usually pay high dividends. It's considered to be a very defensive play. Traders, investors usually don't buy energy stocks for an investment. They buy an energy stock to hide their money during times of peril. Now, what we'll see here, these are the top performers. These are the top performers in the year 2024 on the left-hand side. They most closely correlate with the weakest stocks on the right-hand side of the screen. Amazon under consumer discretionary, many of them under information technology, including Apple, Adobe, Broadcom, etc. And then, of course, every single one in the Mag 7. The takeaway from this is what was the absolute strongest in the year 2024 is now leading the market down, and it most closely correlates with the S&P 500 during those big down days, days when it's down at least 1%. Now, in addition to that, Treasury yields are also breaking down. We spoke about the Treasury market the other day. It's been very quiet, almost kind of boring. While here in yellow, S&P 500. In blue, that's a 10-year U.S. Treasury, starting January through present date. First of all, we have a very strong correlation, which, by the way, does not always exist. It's important to mention the correlation is quite strong. Now, when we've seen a little bit of a bounce back up after that February, early March sell-off, 10-year bond yields rallied, as did the stock market. But more recently, in the past couple of days, we've seen a renewed weakness in stocks and 10-year bond yields now breaking down. How significant? We touched lows today below 420, closing the day at 417. We're actually thinking a little bit below that. That represents basically a tie for the lowest low we've seen since March and the lowest low we've seen for several months now. which also, by the way, coincides with that double bottom on the S&P 500. Now, this is pretty significant because what's happening is the 10-year bond is moving like the Fed funds futures that we talk about a lot here in anticipation of better or worse economic conditions. It's not just that it's moving up or down with stocks, but the 10-year bond yield will move down significantly. And I think this looks like the beginning of a significant break lower, only if it looks like economic conditions are weakening. We had poor JOLTS numbers today. We're going to talk about that later this week, among other numbers. And I think that's why we're seeing real weakness in the 10-year bond yield. Now, in real world terms, what does this mean for us? Let's say we invest in ETFs, exchange traded funds. Well, this is a year to date performance of the different ETFs. The Mag 7s, Amazon, Nvidia, Tesla, etc., down almost 14%. XSD, very closely correlated with the Mag 7s. Semiconductors, down 20%. XBI, that's a biotech index, down almost 15%. Conversely, if you were to have invested in energy, XLE, 9.3% to the upside since the beginning of the year, or healthcare, which is also a defensive play, up 8%. So there really is a difference between what we invest in. Now, again, it's not a stock market, it's a market of stocks. There's definitely a divergence between the different sectors. On the left-hand side, we have, and this is, some of the themes that we're looking at here, staples versus discretionary, consumer staples versus consumer discretionary, things we need like Procter and Gamble and Target and Walmart versus things that we may want like Amazon or Nike or Starbucks. Energy versus innovation, Duke Energy, Exelon Corporation, etc. We need energy versus the innovation we would invest during prosperous times like NVIDIA, the AI technology, Meta, Google, etc. So we're seeing a real divergence, and it's important to note the correlations that are happening is that during the up days, we would expect optimism to come back. But the up days, money's just moving into defense. During the down days, the capital is being taken out of the speculative, the growth side, the considered to be more risky side. Now, we have a lot more, probably more numbers this week that are very, very important. ADP employment, that's on Wednesday. Following that would be factory orders. And then the big number at the end of the week is the U.S. employment report. Today's JOLTS number was really not good, and there's a lot of speculation we're going to see a similar disappointment on Friday's numbers in the non-farm payroll. That's left to be seen. But certainly keep the different correlations and divergence in industry groups in mind. We hope this has been helpful. We look forward to seeing you back soon.